Hi, welcome to Market in a Minute. Did you catch the Ohio State Michigan game? God, that was great, wasn't it? I knew they were going to win. I told you guys they were going to win. So what I've been doing all season long, is I've been betting on the Buckeyes to cover almost every single game. I didn't do the Purdue game, and I turned out I should have, but it's been a nice winning strategy. And the Indiana game is 5.5 points. That's all. I don't think Indiana can compete with the Buckeyes. Indiana maybe has a couple of people on the team that'll that'll be pros, be drafted. Uh, they'll be fired up for sure playing in their home state. But it's gonna be hard to beat the Buckeyes when half the team or more will be in the NFL. That'll start this year. So lots of NFL players on that team. They're really tough. Some people say that was their first test against Michigan. I doubt that, but they looked really good. The score could have been a lot worse for Michigan, particularly if it was played inside like it is going to be this Saturday. So, big message this week: don't fight the Fed. Don't fight the Fed. Fed's going to cut rates. However, we should be concerned about Powell's attitude in the news conference. So his attitude last time he had his news conference was pretty negative. So I think some of the bitterness about being replaced might be coming out. However, next year rates are going to be a lot lower. I, I'm not going to guarantee it, but they're going to be a lot lower. That's our opinion. Another scary valuation chart we have is the Buffett indicator, and I'm going to show you why it makes no sense. The stock market update. We had a nice broad rally, right? Came down over 5%, hit the 100-day, bounced very nicely. We got a buy signal there. Worked very well. Now it's up to a resistance level. We'll have to see if we can break through that. So a little concern, as I mentioned, about the Powell's news conference next week, about them maybe saying they're not going to cut rates next year. They're going to cut rates. He just won't be there. But anyhow, we could get a negative reaction out of that. And then, so the easy money's been made, right? We had this nice bounce back to where we were almost. Easy money's been made, but the seasonality, and I gotta say, I got burnt by the seasonality this year. August and September were just fine, but the seasonality in December since 1950, the stock market's up 79% of the time. Kind of hard to ignore that. So we think the leading stocks will be just fine. The stocks that have been underperformers, maybe they're down on the year, they're being pressured by tax loss selling. Got to look at those to pick some up during December. There's some really good ones. I really like On Holdings, right? ONON. That's one it's a really strong grower. It's comparable to Nike in our opinion in the younger days of Nike. It's got a lot of growth in front of it. Great technology. I own 3 pairs of shoes. Maybe Santa's listening, will get me the boots too. So I've got 3 pairs of running shoes and maybe the boots as well. So anyhow, the Fed will cut rates from 375 to 4% down to the high end being 375. And as I mentioned, we think they're going to go lower, maybe 3% by year end. And I tell you, it depends on who gets on the board, the chairman of the board, and what sort of influence he has and where inflation is. But you might be able to see inflation down at 2% and the Fed funds rate down at 2.5 or maybe even lower. So that would drive a lot of economic growth. And we have some fiscal stimulus coming as well. But we think what's happening is that the PE ratio of the stock market itself is kind of where it should be, or maybe too high in general. It's too high for some of the technology stocks. Hard to find good stocks to buy in that area because they're all highly valued at this point. A lot of them are, and so we've been playing some of them, but not the extremely high valued ones or ones where we're going to see a lot of competition come after their business. But we think that the AI infrastructure play will probably be okay. Those stocks will probably grow in line with their earnings growth next year. or something like that, maybe a little bit less, and that money will start to flow into other sectors of the market that have faster growth. Now, keep this in mind, like the energy sector. The energy sector is 3%. I don't think the energy sector is going to be a great place to be, but 3%, that sector could double in value, okay, go to 6% of the S&P, and it probably wouldn't make much of a dent at all to the valuation of the stock market. So what I'm saying is you could see some sectors of the stock market pick up in terms of their earnings growth, maybe not change the valuation much of the stock market, but has some really good companies in there. So this is the Russell 2000. The Russell 2000 has been flat for almost 5 years now. From the high, now it broke through the old highs and it's breaking out. So we think the small cap stocks will be one of those areas that could be really interesting next year. Small caps consumer stocks, really like those. Like American Eagle. Remember this one? We were buying it below 10. Their jeans are just on fire right now. So some of the stats I've been seeing is that their jeans are selling 200% of what they were selling last year. So there's going to be some good growth in some of these consumer companies. Financials like them as well. As you know, okay, when interest rates come down, the short-term rates come down, long rates don't go up as much, so you create this bigger profit margin for the financial stocks. Healthcare, we think healthcare is coming back. It's performing very nicely. And the small and mid-cap companies are the place you want to focus. So as some of that weighting in tech moves around, compresses, it'll come into these other areas of the market. And maybe it doesn't have much of an impact on the valuation of the overall stock market itself. Or maybe the stock market valuation comes down as these companies accelerate in terms of their growth rates, and being such a small part of the S&P, it doesn't have much of an impact. Keep in mind, JP Morgan conference. So it's not just JP Morgan. It's a lot of other broker-dealers have their conference at the same time. But it's called the JP Morgan conference, second week of January. There's going to be a lot of companies there, a lot of big cap companies, pharmaceutical companies looking to make deals, looking to buy these smaller companies that have technology. So it could be a really fun period. You want to get positioned before the JP Morgan conference. So if there's a company you're looking at, like we like CRISPR, that's one of our new ones, gene editing. It's a mid-cap company, roughly $5 billion market cap. That's something that these large pharmaceutical companies will want to have. They'll want to own that technology. The one big beautiful bill is kicking in. We think it's going to add 1 to 2% GDP growth next year. You got the lower tax rates. They were all grandfathered in from the start of this year, so there's going to be some big refunds in 2026. And then you have a lot of capital spending incentives from this bill as well. So what you don't want to do is you don't want to own the Walmarts of the world. You don't want to own the mega cap companies. They aren't going to grow as fast. You want to get out of those. Now, we still like Amazon, but Amazon has a similar problem as Walmart. And we still like it. We think that the company's undervalued, that they have many, many things to do to increase profitability, and their web services business is growing very nicely. So we think that stock is undervalued. But look to the smaller cap companies or mid-cap companies. The financials, we like those a lot, as I mentioned, how the profitability improves. And Capital One's probably our play there. So that is a company that's transforming, should have very nice growth. Now the Buffett indicator. Okay, so here's a chart, long-term chart of the Buffett indicator. And when the theory has been when the total stock market value, so all the companies in the stock market divided by the GDP, was above 100%, you wanted to get out of the stock market. And you can see that, for some times here, it was a good indicator, particularly when it hit its peak in 2000 and then hit its peak in 2007. It worked well, but things are changing. The reason why this indicator is not great anymore is the profitability has improved so significantly over time that, if you adjust it for the profitability, then we're below where we were in 2000. Granted, the stock market's high, and we think that the earnings are going to accelerate for different areas of the stock market next year. We think that there's still more upside in the stock market. We're concerned about valuations in general, so we want to play those companies that don't have really high valuations, that still have good fundamentals. We think you don't have to own just 7 or 10 stocks. You can own a broader basket of stocks that are probably going to grow as fast or faster than that technology sector next year. So the market's expensive. We like buying individual stocks that have really good upside. What we're doing is we're looking at those companies that maybe had some tax loss selling associated with them that have really good upside. We want 50 to 100% type of upside in individual stocks. And in the healthcare space, we're looking for 5 and 10 bangers. So we think that next year could be a really good year for individual stocks. Maybe not as good for the overall stock market. Would expect volatility. Kind of thinking next week we're going to get some volatility with Powell, but we're not a buy the dipper. We're buy the right asset at the right time. So be opportunistic. Thank you. If you have questions, come to our website, Patrick Adams CFA, and ping me. Come to also sign up for a hard copy of Market in a Minute. You could do from my website, or you can come to PVG Asset Management. You can also contact us through that website as well and see some of the strategies that we manage. Go Buckeyes!